Paul, it's great to have you on, and let's start right there. What are you looking at that indicates that momentum is slowing?
Yeah, thanks. No, we're starting to see the gains be a little bit less than they were in previous days. A little bit like throwing a ball in the air, where as it gets to its peak, its rate of increase or its rate of climb gets less, and then you get the ball falling. So could the market fall here? Yes, absolutely. As we saw in January, it would only take one sort of piece of unexpected news to wrong foot a rally like this, and then all of a sudden you're looking at a pullback. Now, we don't think it's the end of the trend, not by any means, but we just think that there's ways to diversify our exposure to that trend. Happy to talk about those if you like.
Yeah, let's do that. How would you diversify?
So, okay, in the first place, earlier this year, we were overweight, I should say, both communication services and information technology, two sectors in the S&P 500. After we got to the peak or started running a good rate of clip in May, we pulled off in comm services. So we only have one overweight among the hyperscalers. What else could we do? Well, there's other ways to play AI. There's the data center angle on all of that. So we eventually went in long and overweight utilities and industrials. That's where we are right now. And if you notice on a day-to-day basis, those are right around the borderline of outperforming or not outperforming the overall composite index. So these are two indices that probably have some ways to go further before they get overvalued. Okay, so that's an alternative way to play here. Buy something that's cheap, but that aligns, that's related to that overall AI trend. And then a third way is to look for other trends in the market that are reliable. And we think one of the best and most reliable trends here is that we think short-term interest rates are going to fall. Probably two more Fed rate cuts this year, two more rate cuts next year. We've already seen the curve, the maturity curve, the yield curve steepen from the short end falling, long end rising or staying the same. Who's that going to help? Banks. Banks pay deposits on the short end of the curve. Those rates are falling. Bank costs are falling. But on the long end of the maturity spectrum, you've got steady to higher yields, and those are the rates that banks charge for loans. So it figures costs go down, revenues go up. We like financials. This is another trend that you can play so that your money isn't completely locked up in one basket that could have a pullback or a correction.
Do you stay domestic? And I ask that looking at the fact that today is a 6-month anniversary of the tariff crash low after Liberation Day. Yeah. The S&P is now up more than 35% since then.
Yeah, we're going to stay domestic. Look, in the early part of the year, the international markets outperformed. But since that low, the U.S. has maintained itself with those markets, staying neck and neck with them. Why would we stay with the U.S. then? Well, because we think the fundamentals are better here. We think growth improves next year while interest rates are falling. That's not a usual combination to see growth improving while interest rates fall. Usually you see rates rise. So that's a really great combination for mergers and acquisitions. It could help business development companies. It could help any number of alternative investments as well. So we like the U.S. not just because it has those positive fundamentals, but because we're starting to see some real strains overseas. You look at the electoral problem, the political problems in France and in the U.K. Both of those are related to debt that seems unsustainable. So those bond yields are going up. We don't want any part of that right now. We see some risks still in China. We're underweight emerging markets. We would rather stay home and just try to diversify. So, again, all of our eggs aren't in just one thematic basket.
Okay. Paul, quickly then, do you go anywhere near fixed income?
Yeah, absolutely. Take a bullet strategy here. I said before, short rates are falling. Long rates are kind of volatile up and down. Let's stick with those maturities, 3 to 7 years. Call that intermediate range. The yields are almost like what they are in 10 years, but you don't have the duration risk. You don't have the risk from the up and down in the yields. And we would stick with investment grades. Corporates, treasuries, munis, essential service, and general obligation munis, best places to go there.